America blinked first. The United States, the world's foremost military power, quietly requested a ceasefire from Iran. The response came on American television. Iran's Foreign Minister Abbas Araghchi appeared on NBC's Meet the Press and delivered an unequivocal answer. No. This presents a paradox. Why would a superpower ask for a truce? And more importantly, why would a regional power, under immense pressure, refuse? Understanding this reversal is not just an academic exercise. It reveals a recurring pattern I call the commitment trap, a dynamic that, once you see it, becomes critical for positioning your portfolio. But before we decode why Iran refused, we must first analyze the strategic failure that forced the United States to ask in the first place. That strategic failure has a name: Operation Epic Fury. On paper, it was a classic overwhelming strike. Within roughly 10 days, the plan promised rapid degradation of Iran's command structure, decisive regime destabilization, and a clean exit before serious retaliation or market fallout could take shape. The expectation sold to decision makers was speed, control, and limited blowback. In reality, each of those assumptions inverted. 10 days in, the regime was still firmly in place. US forces were still engaged, and the initiative had shifted. Instead of folding, Iran answered with a large, coordinated counterattack. More than 500 ballistic missiles and 2,000 drones launched across multiple theaters. US and allied air defenses had to fire interceptors at a rate they had not planned to sustain, rapidly depleting Patriot stocks, exposing a critical THAAD radar in Qatar that was destroyed, and leaving 7 US soldiers dead. The short, decisive gambit had become an open-ended exchange with visible losses and no political breakthrough. The military setback fed directly into the one channel Washington could not afford to lose control of: energy prices. Global crude spiked, with WTI up more than 38% in a single week, the sharpest weekly gain since 1985. Benchmarks pushed through $100 a barrel and briefly printed near $190. It was a textbook case of strategic blowback. A move meant to demonstrate dominance instead ricocheted through oil markets and back into the US domestic arena. For anyone running capital or policy, that kind of move signals not a contained skirmish, but a serious, sustained supply risk that will show up at the pump and in headline inflation. In the US system, fuel prices and inflation expectations translate quickly into approval rating damage, congressional pressure, and electoral risk. As the oil shock reset market forecasts for gasoline and broader price levels, the administration's tolerance for prolonged escalation narrowed. Stabilizing energy costs and containing domestic political damage became overriding constraints. Under those conditions, shifting to a ceasefire request was less a discretionary gesture than a forced move. For anyone managing risk, the more important point is that this failure was predictable, not random bad luck. Before the attacks, a classified US National Intelligence Council report had already concluded that a large-scale assault was unlikely to topple the regime given the depth of its power structure. In plain language, the intelligence community warned that the central promise of epic fury, rapid regime change at acceptable cost, was low probability. Yet the operation went ahead largely unchanged. That gap between analysis and action reflects structural misalignment. Political incentives to demonstrate resolve, reassure allies, and preserve deterrence optics overrode the intelligence community's own odds of success. So the US request for a ceasefire was not an act of magnanimity from a position of strength. It was a tactical adjustment imposed by a failed initial gamble and rising domestic costs. That clarifies where Washington actually stood at the moment it came to the table. But it leaves a sharper question on the other side of the board. Why did Iran, under heavy economic and military pressure, publicly reject an offer from a superpower-seeking off-ramps? The mainstream narrative writes this off as irrational pride. What we will see instead is a cold, historically grounded calculation shaped by 2 prior episodes of negotiating under fire. A pattern that sits at the core of what I call the commitment trap. That calculation is rooted in a recent pattern. The United States has attacked Iran twice during negotiations. In Western coverage, Tehran's refusal is explained as ideology, wounded pride, even martyrdom, refusing a ceasefire because it can't back down. But once you look at US actions, that same refusal looks less emotional and more like the only move a rational actor makes after repeated betrayal. From Tehran's perspective, a ceasefire is not a step towards peace, but a tactical trap, allowing an adversary to regroup and rearm. This isn't paranoia, it's pattern recognition rooted in 2 shocks. First, the US unilaterally withdrew from the JCPOA nuclear deal in 2018, after years of negotiation and assurances that following the rules would bring sanctions relief. Second, a 2020 US strike killed General Soleimani, one of Iran's senior military figures. In Washington, those decisions were sold as toughness. In Tehran, they signaled that neither signed agreements nor senior officials are protected when Washington's politics shift. The decision tree is simple. When engagement brings escalation, you stop offering reversible concessions. Iran's foreign minister, Abbas Araghchi, points to the June 2025 12-day war and the bombing of Tehran on February 28, 2026. Both, he says, occurred while talks with the United States were underway in Geneva. His words were direct. We negotiated with the United States twice, and every single time they attacked us in the middle of those negotiations. Therefore, Iran's demand is not for a pause. It is for a permanent, structural and irreversible end to the war, meaning not just a ceasefire order, but changes in posture and guarantees locked in so they cannot be easily reversed by a future crisis or administration. This is the end state of the commitment trap. One side demands a guarantee it knows the other is unwilling or unable to provide. That is the real source of the deadlock. We see this commitment trap dynamic in markets and business. A management team that repeatedly sandbags guidance, or a borrower that breaks covenants in a downturn, discovers that no new promise restores trust on the old terms. In your own deals, portfolios, or command roles, where have you seen prior breaches make any fresh offer non-credible, however attractive? Map that pattern in the comments. But even if political leaders on both sides bridged this mistrust, it still would not be enough. There is a ghost in the machine, a structural impediment deep inside Iran's command system that makes any lasting peace agreement fragile. Understanding that system is the key to seeing what happens next. That system is built on a simple, brutal principle: the deliberate separation of Iran's political and military command chains. This is the ghost in the machine. Western coverage often frames this as the military being out of control, when in reality this dual-track authority is a deliberate feature of Iran's security architecture. It's built for survival, so the state cannot be paralyzed by a decapitation strike on its political leaders. More importantly, it's the architectural consequence of assuming betrayal, the hardware version of the mistrust we mapped in the previous chapter. In practical terms, it's meant to prevent an enemy from using peace talks as cover for a surprise attack. As the New York Times and BBC reported in March 2026, Iran's President Pezeshkian issued an apology to Gulf neighbours for recent strikes, a clear diplomatic signal that hardliners immediately attacked. Yet, within hours, the IRGC launched a new wave of attacks under its own authority. Reporting from PBS Frontline and the Jerusalem Post shows that the IRGC operates with designed autonomy. Its decentralized command lets it resist civilian control and sustain operations under pressure. Reports citing IRGC sources quote commanders saying they are prepared to sustain this level of conflict for up to 6 months, and that lower-level officers have been granted autonomous combat authority. This means any diplomatic signal is a weak predictor of strike tempo, target selection, or regional escalation. So we have 3 forces at play. The United States, caught by its own failed military calculus. Iran, operating from a rational mistrust born of repeated betrayal. And this internal dual command structure that makes de-escalation a logistical nightmare. These are not separate. Together they feed a single dynamic that governs this conflict. A game theory principle I call the commitment trap. Understanding it is key to seeing what happens next and how capital will move as a result. Imagine trying to close a deal with a partner who sabotaged you the last 2 times you negotiated. Whatever they promise now, you assume it's a setup against you. That, in essence, is the commitment trap. It appears whenever 3 conditions line up. One side urgently needs de-escalation. The other has rational mistrust rooted in past betrayal. And there is no credible way to enforce whatever is agreed. Whenever you see those 3 ingredients in any conflict, you're not just facing a hard negotiation. You're looking at a commitment trap. Washington's failed military calculus has created the need to step back and cut losses. Tehran's experience of being attacked in the middle of past talks makes any American assurance look like the setup for another blow. And Iran's dual command structure means even a sincere diplomatic signal can be vetoed by the military wing, so enforcement is never guaranteed. Failure creating the offer, mistrust blocking acceptance, and the state's architecture making any deal non-credible. That is the commitment trap in motion. Game theory calls this a classic commitment problem, and analysts at places like the Atlantic Council and Real Clear Defense often describe it as a distrust equilibrium. Past actions shred credibility. Each side expects the other to cheat or exploit any pause, and the safer move is to hit first or refuse to pull forces back, turning distrust into an escalation spiral where renewed violence becomes the default outcome. Ceasefire itself exposes the trap. For Washington, it means a tactical pause to regroup. For Tehran, after being hit twice during past negotiations, it means a trap. Stop, lower your guard, invite the next strike. For Gulf states, it means sustained calm to relieve economic pressure. Those meanings may briefly overlap, but they drive incompatible end states and timelines. Washington planning to resume pressure, Tehran bracing for betrayal, the Gulf needing durable stability. Each side assumes the word masks a different agenda. That is the commitment trap embedded in the language of de-escalation. This is why the current stalemate is not random chaos. It is the logical outcome of the incentives we've mapped, and markets treat it that way. The trap isn't that the parties cannot sign an agreement. It's that, given this history and structure, it is rational for each to treat any promise as non-credible. That uncertainty, highlighted in energy and MENA macro notes from firms like Morgan Stanley and Goldman Sachs, shows up as risk premia on the region, rotations into defense and energy names, and a bias to price in prolonged conflict rather than clean resolution. If you stop at that diagnosis, this is just interesting news, and your capital stays aligned with a resolution the structure is working against. The next chapter turns the commitment trap into a concrete playbook for repositioning. Without it, you're trading into a system wired for recurring flare-ups with no meaningful hedge. This playbook rests on one principle. We are no longer managing a brief scare, but a long-running condition. The commitment trap has locked in a stalemate that embeds a persistent geopolitical risk premium into markets. Instead of one spike and a return to normal, you get a higher baseline of uncertainty that shows up in longer-dated pricing and volatility, not just in headline moves. Start with energy. Oil buffers are thin, roughly 10 to 14 days of storage before a supply shock bites. When 20% of global supply moves through the Strait of Hormuz, any sustained disruption hits prices fast. Bloomberg estimates a prolonged closure could push crude toward $140 a barrel. That's why this is no longer just a low-probability tail event. The system has to price an ongoing chance of interruption. That backdrop forces capital to reposition, not just trade the headlines. In the early phase of the conflict, gold moved more than 3%. A small but telling sign that large players were buying insurance, while public commentary still called it temporary. That's the tell. Risk assessment sits in price, not in statements. From there, the key shift is institutional. Outlooks from firms like Capital Economics warn that a lingering conflict keeps energy prices elevated, making inflation sticky and central banks cautious. That slows rate cuts and holds up yields at the front of the curve, even as flare-ups send safe haven flows into treasuries. In that push-pull, you favor shorter duration government bonds and pair them with assets that benefit from higher energy, like North American producers, and a core allocation to gold. Markets are no longer pricing in a quick resolution. They're pricing in repeated disruptions to energy, inflation, and bond yields. To front-run that, use a simple stalemate dashboard. 3 signals you can track and translate into position size, sector tilts, and interest rate exposure. First, war risk insurance for tankers in the Strait of Hormuz. Track it through shipping and insurance commentary on Gulf tanker rates. A meaningful move is premia roughly doubling from calm levels and staying there. A cue to avoid being underweight North American energy and leveraged shorts in the sector. Second, the rhetorical gap between Iran's IRGC and its foreign ministry. Use newswires or regional analysis to track their statements. If the IRGC keeps talking escalation while diplomats sell compromise over several news cycles, treat any ceasefire as fragile, cap risk on exposure, and favor higher quality credit over stretching for yield. Third, capital flows into gold versus broad risk assets. Watch weekly ETF flows, futures positioning, or the fund flow summaries your broker provides. Sustained inflows into gold alongside outflows from equities or high-yield credit are a signal to raise cash, keep bond duration moderate, and let gold and energy producers carry more of the inflation hedge role. If all 3 are flashing red, treat the commitment trap as tightening and move towards your defensive settings. If only 1 or 2 are elevated, lean defensive, but shift in smaller steps. These signals turn a messy stalemate into a repeatable process for protecting your capital. But beyond capital flows and risk metrics, there is another ledger to consider. That other ledger is where the commitment trap stops being theory and becomes unspoken human cost. For a family in Tehran on a Sunday morning, that cost is closing the windows against the stench of burning oil depots as black rain runs down the balcony glass and children ask why the sky looks like smoke. History has a word for wars where each side is trapped in its own logic. Sure, the other will give in first. It is not a short word, and it is never a cheap one. That is the part of the commitment trap ledger markets ignore, until it hits portfolios and lives. If this framework for understanding risk was valuable to you, subscribe for more analysis that cuts through the noise.